Assalamu alaikum, guys. We are still reviewing this misconception about Islamic banking today, and we are looking at misconception number 3. That is, the Islamic bank is driven by the profit-loss sharing system. And what we have said earlier, that this is not all true. So we need to clarify this statement by looking at the banking framework from the three dimension, namely the funding side, the asset side, and capital. Because generally, the description about Islamic banking would refer to the asset side. Islamic bank provides debt financing, to facilitate the purchase of property and automobiles and whatnot, but we have to look at the banking business, in a more broader manner, which many have eluded, and that would be the funding side and the capital side. As I have mentioned earlier, the funding side or the sources of fund is a very critical component of the banking business, because these are the funds that the bank uses to make loan or to make murabaha. And once these funds are disclosed as deposit, whether the bank is conventional bank or Islamic bank, once it has been disclosed as a deposit fund, then the Basel Committee of Banking Supervision will see this as a loan that the bank acquire from the public or from the depositor by issuing the current account, saving account, and fixed deposit fund. So as a deposit fund or as a loan fund that the bank acquire from the public, these funds have a common character, namely that the fund must be protected in full. That is, at maturity, the bank must redeem the full value of the deposit plus interest. Of course, for current account, there is no interest, but for saving and fixed deposit, there is an interest income earned by the depositors. So at maturity, both the deposit fund and the interest income is to be given back to the depositors. At the same time, the depositors can withdraw their money on call. So this is the nature of the deposit fund, which is a loan that the bank acquire from the public. And because it is a deposit fund, it is a loan, it is a protected fund, the Basel Committee of Banking Supervision is making sure that the bank must protect this fund. Right? The bank must have a proper moral and ethical standing to ensure that the loan they make by using these funds are good loans. So we have prudential regulation to ensure that loans or murabaha are issued are good ones, a good murabaha or good loan to prevent any form of default or serious default that can occur. So if there is a default in the loan funded by deposit, then it will smell trouble because this deposit are not money belonging to the bank, it belongs to the public, and any default in the loan or murabaha will cause loss. But who will bear the losses? So the Basel Committee require the bank to hold enough capital against the murabaha or against the loan issued by the bank. But this capital are not one-to-one, meaning that We are not saying that $1 of a loan is supported by $1 of capital. Usually, the capital adequacy ratio is about 10.5%. That is, for every $1 of loan funded by deposit, the bank must hold at least 10.5 cents of their own money. So in case if there's a default in the loan, then there is enough money of the shareholders to absorb the losses. And that is the role of capital, because the loan or murabaha issued by the bank are not coming from capital, they are coming from deposit fund, and thus we will see that the Basel Committee is very serious to ensure that there is no moral hazard, there is no irresponsible lending or aggressive lending by the bank that may jeopardize the safety of the deposit. So that is why we have banking regulation, we have regulatory capital to support the murabaha or to support the loan in case there is impending default. So that is why when the Islamic bank have disclosed that their deposit funds or that their funds are deposit, and they are therefore required by the Basel Committee to hold adequate capital against the murabaha, against the tawarruk, right? So these deposit funds are not PLS funds, these are not profit sharing funds, these are essentially debt fund that can pose danger to the bank when these funds are used to make murabaha and tawarruk that can eventually get into trouble. So the regulator require the Islamic bank to hold enough capital against the murabaha or the tawarruk. So the idea here is, I repeat, that because the sources of funding are not PLS, they are debt financing. So the Islamic bank are required to hold enough capital against the tawarruk and against the murabaha issued by the bank. So this is the fact that we must be able to accept that on the funding side, the funding are mostly coming from debts. Of course, as we have said earlier, that in some jurisdiction, we have mudarabah deposits, meaning that this mudarabah deposit, mudarabah is an equity, deposit is a debt. So there is a combination of debt and equity. So I have discussed this matter earlier with regards to the alpha factor that will define the risk borne by the bank and by the investment account holder. For Malaysia, it has been instituted that the deposit fund to be segregated from the equity fund. So there is no mixture of deposit fund and investment account fund, and that would make it easier to manage the funding, so that we know very well that once the deposit fund is a deposit fund, it is a debt, and thus the bank will carry all risks associated with the murabaha financing, with the tawarruk financing. And when the fund are defined as investment account fund, then the risk in the murabaha or the risk in the venture is now borne by the investment account holder. So the bank is not required to hold any capital against the asset financed by the investment account holder. But when we are looking at deposit funding, then the bank are required to hold capital against any asset funded by the deposit fund. Okay guys, we can stop here. I'll discuss a bit more later as we move on to discuss about this misconception or about Islamic banking today. Assalamualaikum warahmatullah. Thank you.